battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 44 long years, Stenger Family has made it our mission to deliver both clarity and confidence to help secure your financial future. Here we go, episode 202. We are back at it. We came off of episode 200, which is almost at 3,000 views across all the different platforms that we run. Go watch that if you haven't already. Episode 200, we did it live. And then we did our episode 201 last week talking about socialism and what's going on in New York City. Well, this week, episode 202, we are going to talk about how to invest when the market is at an all-time high, investing at the peak. But before we do, please register for Investor Day. It's coming up very soon. We are almost full. We sent out the last email that we're going to send out yesterday and immediately got another 15, 16 signups. So we're almost at max capacity. We've got room for another probably 7 or 8 couples, another 15, 16 people. If you were thinking about coming to this thing, this is your last opportunity to register, and then we will have to cap attendance October 16th and 17th in Oak Brook at Gibson's. Don't miss this thing. 3 amazing guest speakers. Investor Day coming up right around the corner. We're going to tell you what we're doing with the portfolio and our due diligence findings for the upcoming new year. All right, episode 202, here we go. The S&P is at 6,600 points. Now, remember, going into 2025, at the end of 2024, we like to do our market outlook show for the new year. We said S&P would hit 6,700 points by the end of 2025. Well, here we are. We're just about 100 points away midway through September, and I do think we're going to hit the 6,700, possibly exceed it. We'll see. If we exceed it by a lot, some sources like Tom Lee are saying we could hit 7,000 in the S&P. That's going to be too much, and then you're going to see a pullback. But I think pretty much from here till the end of December, you're going to see 6,700. You may see some choppiness, see a down day, 1% or 2% here or there. But I think the worst of the correction is behind us. Remember, all the Wall Street strategists and pundits who were bulled up going into 2025, excited about the market for 2025, immediately cut their estimates when tariffs came out. And then April 7th of this year was the actual bottom. And most of them on April 7th, almost to the day, told you to panic and run for the hills and buy gold bars and never buy stocks ever again, that the tariffs are going to push us off a cliff. I think that was probably a pre-recession signal. I think at some point we are going to have a recession. It's coming down the road. But the market always bottoms in advance. So when you're going through that bottom, that's not the time to panic. This is why I tell you can't time the market, because everybody already knows all the same information. The best traders on Wall Street are using algorithms. They're using AI now to trade portfolios. So the idea that you would be sitting here in Naperville, Illinois, Houston, Texas, Baton Rouge, somewhere in the middle of America, somewhere here like us, and you have more information than the best traders on Wall Street, you are incorrect. You do not. There's no way you're going to outsmart the market. You're just not. And so market timing is this 2-part exercise where not only do you have to be right getting out, but you do have to be right twice and know when to get back in. That is always the challenge. Ultimately, what happens is people maybe can trade it once or twice. I heard a story yesterday of this guy who he traded it perfectly in 08 and 09. He missed the entire market bottom, but then guess what? He was so scared of the market after 08 and 09, he never got back in, and now he missed out on the run of the past 10, 12, 15 years coming out of the financial crisis. So again, it would have been much better just to stay invested across the entire cycle. But what do you do if you're saying, Nick, the market's at all-time record high, I was waiting to get invested, I goofed up, I should have gotten in, I didn't do it. What can you tell me about where the market is going to go if I get in at 6,600 today? Well, statistically speaking, over any 5-year rolling time frame since 1950, if you only invested at market peaks, you would have had a 50.1% return, total return, over the next 5 years, which is actually 1% higher, surprisingly, than if you only invested on the other days, the non-peak days. Surprising, but statistically it's true that it doesn't matter. Even if you invest at the record all-time high, but you're doing it on a goals-based plan, meaning that you've got money for a rainy day, you've got some backup cash, you know what to do in case things go badly for you, you don't have to sell your stocks, you're going to be okay. You're not going to get blown up. I did have somebody the other week say, hey, Nick, I've got $400,000 or $500,000 sitting at the bank. I wish I got them invested back in April. I didn't. I feel like I missed it. Now the market's at 6,600. Do you think I still should get in? And my response was, well, when are you going to need the 400 or 500 grand? Do you have a goal that's coming up where you're going to need that money? And they said, well, I might need about 100 of it in the next 12 months, but the other 400, I'm good to go. As long as I have that $100,000 cushion, I'm going to be okay probably for the next 3 or 4 years and not have to touch the other 400. And to which my response was, well, let's keep the 100 safe and let's invest the other 400. So it doesn't have to be an all or nothing approach, but it does have to be a goals-based plan. So a lot of you have been on what's called a risk-based plan. If you haven't been with Stenger Family Office as a client, our clients are on goals-based plans. What we want to do is at the very first meeting, get an idea of what do you want to accomplish. You probably don't want to run out of money while you're alive. That's the biggest goal, obviously, for all of us. But the second goal would be midterm things, bucket list items. Maybe you have a wedding you want to pay for. Maybe you want to buy a house. Maybe you want to help grandkids. Maybe you want to give to charity. You want to take trips. You have your goals that we will build into the plan. And then you have short-term goals, which are going to be how do you make sure you don't get blown up when there is a bad time in the market? Not if there's a bad time, but when do you have enough cash for a rainy day? So those are the buckets that we use. Those are the 3 buckets. And once you have this goals-based plan, now you can go into those buckets and you can invest them according to when you're going to need those resources. Because even in the worst market declines, even in 08 and 09, even in 1999, 1987, Black Monday, COVID, all the rest of them, the average time to recover is about 28 months. So if you're not going to need 100% of that money for 28 months, statistically, odds are in your favor, the market's up. The other question I always like to ask our clients is I say, well, do you think the market's up in 5, 6, 7 years from today? And the answer is almost always yes. In fact, I don't think I've ever met one of our clients who thinks the market's going to be lower 7 years from today than it is right now. And so if you know that, if that's the driving light behind your investment philosophy, you're going to be an optimist over time. You don't worry about the downturns in the short run. You don't worry about geopolitical. You don't worry about all these terrible things that are happening all around us in the world. You just focus on your long-range plan. And if you do that, you'll be successful. It's similar to one of my clients who years ago said, Nick, what's going to happen if we get nuked by North Korea? What are we going to do with the portfolio? And I'm like, well, if we get nuked by North Korea, the portfolio is the least of your concerns. So just put this all into context. We have to separate rational fears from irrational and what we can actually do about it. What can you actually do about it? You have that safe goals-based part of the portfolio, the money that's there for the next 2-3 years of living expenses if you're retired, that you're not touching, you're not risking it, you're not worried when the market goes down. That's your safe bucket. Every other dollar in the portfolio is growing. Now, here's the reality of the past couple years with COVID and all the money printing that's gone on. We have printed about 40 to 50% more M2 money supply into the economy. And if you were following Milton Friedman from University of Chicago, won the Nobel Prize for this study, he said when you print money, inflation goes up. It's not rocket science. So what's happened the past 4 or 5 years? Well, house prices have gone up about 40, 50%. Harder than ever for millennials to buy a home. You have had stocks go up about 100% the past 5 years. Actually, the biggest and best stocks have gone up about 115% the past 5 years. And so you look at the price of assets, and assets have at least kept pace with inflation. But if you're in the best quality equities, the ones that can beat inflation, use technology, not only are they keeping up with inflation, but they're beating it handedly. So yes, you've seen your prices at the pump go up, you've seen your prices at the grocery store go up, but you're also seeing the S&P at record all-time highs. Now, the big question is, aren't we in this massive bubble? That's always the question we get. We got it at 6,000 points, we got it at 5,000 points, we got it at 4,000. We got it at the 3,000 point level. We've gotten it every single time along the way. And yeah, the S&P is at a brand new record all-time high, but it's important for you to understand why the S&P is at an all-time high. It's not just because valuations have soared to unsustainable levels. It's not because valuations have gone up with no growth in earnings and no growth in real technology. In fact, it's been the exact opposite. We've seen earnings on the S&P 500 go up almost 10% a year here for the past couple of years. And in the best companies, earnings have gone up closer to 15%. And that's reflected in their stock prices. The best companies have gone up about 15% per year the past 5-6 years. So what does that tell you? It tells you that the market is just keeping up with underlying fundamentals. Now, if the market's valuation goes from about 22 times forward earnings, which is where it's roughly trading today, and you see that number go to 40 or 50 or 60 on the general market, watch out. Be careful. And I will, on this show, tell you, watch out. We've got some pretty lofty stock prices, and there's ways around that. There's ways we can deal with that. I had a client who asked me a couple weeks ago, Nick, if that does happen, what do you do? Well, there's easy ways to deal with that. You can pivot towards a little bit more cash. You can also pivot towards more value-oriented securities, which is what we did in the 2000s to 2010 when we had the great financial crisis, that 10-year period that everybody calls the lost decade. And we were able to still get a return in that era too. It's just different investments. That's the key. But we're nowhere close to that. Don't keep yourself up at night worrying about the S&P's price because we are not radically overvalued. In fact, I think what you're going to see is earnings for 2027 now. That's how far out we're looking. Earnings for 2027 are going to exceed expectations, and it's going to actually push the fair value on the S&P closer to 7,500 points. Do not be surprised if you see 7,500 on the S&P, and you're going to have the same question for me then that you had today, which was, well, I'm investing at an all-time high. Isn't that scary? Isn't the market overvalued? Well, as long as the math still checks out and we're trading about 20, 22 times forward earnings, we're still going to go up. Over time, earnings drive the market. Now, the exciting times that we're living in are all driven by this technology innovation wave. Some people call it the fourth industrial revolution. Some people just say it's machine learning, the cloud AI. But we are just at the cutting edge of what's coming. You have no idea what can happen at some of these large Fortune 500 companies who are not even inventing the new technology, rather just leveraging it, and they're finding new ways to reduce their costs, which again does what? It improves earnings. And what happens when earnings go up? Their stock prices go up. So that's what's coming. And so just be excited for the future. I'm telling you, there's so much coming that you have no idea about. You have no idea what the tech is going to look like 5 years from now, 10 years from now, but it will be better, faster, and it's going to never move as slow as it did today. And because of that, you got to stay in equities. What happens when you invest at an all-time high? I think probably, if I had to read into the crystal ball, we may see a correction if we hit the 7,000 point too soon, back down about 10%. That'd be very typical. That puts the S&P in that 6,300 point zone, not radically far off from where you're at today. So some people would say, well, I'll just wait for that 6,300 number and try and just time it out and wait for a correction. That's a mistake because I could be wrong about that. The market could just keep going up after that, especially if earnings are better than expected. So if you've got the money now and you're looking for a time to invest, get invested. And I could be wrong 3 months from now. We could be down 10%. But if it's goals-based money and you're on a plan, who cares where the market's at in 3 months? You care about the next 3, 10, 15, even maybe 30 years, depending on your time horizon. And even if you're 60 years old, let's say you're maybe going to live till 85 or 90, depending on your life expectancy, well, you got 25, 30 years. So that's why I keep arguing you got to be careful before you get into a target date portfolio, got to be careful before you get into one of these portfolios that I see from a home office where they've got a 60-40. Remember, Vanguard just came out and said 70% to 30%, but 70 was supposed to be the bonds. So forget a 60-40 equity to bond portfolio. Vanguard flipped it, and they say you should be in 70% bonds, 30% stocks. I mean, this is absolutely ridiculous. In my opinion, and now I could be wrong, but in my opinion, that would be a massive, massive mistake if you've got a 20, 30-year retirement ahead of you. So stay on a plan. The only way you're going to do that is get with a fiduciary financial advisor. You can give our firm a call, 630-912-8295, 630-912-8295. Come learn about what we do at Investor Day coming up right around the corner, about a month out. A couple spots left. Don't forget to register for Investor Day, but get yourself with a great fiduciary financial advisor who can get you on a plan that's customized to you. Thanks for being here, episode 202. We'll see you next time for episode 203.